Most beginners make at least one of these 5 investing mistakes. And the painful part, it costs them real money to realize they have made the mistake. If you have just opened a stocks and shares ISA or you are buying your first ETF, this video can save you years of frustration. Today, let's look at the top 5 beginner mistakes and how you can avoid them. Most people start investing with no plans. They buy what's trending, they sell when it dips, and they hope for the best. But if you don't know why you're investing, what's your investment risk level, and how long you're investing for, you are not investing, you are guessing. Imagine a road trip without a destination, no fuel stops planned, no sat nav. You will probably get lost. That's what investing without a plan looks like. Here is what a simple plan can look like. I will invest £250 every single month for the next 10 years into a stocks and shares ISA, and I will diversify that using index funds. That one sentence gives you the time frame, the contribution amount, and the rough distribution of your funds. You can add additional clarity to it by adding things like I will review it twice every year, and I will not sell it because I have seen a news headline. So things like that can really clarify what your plans are. You need to tailor this plan to suit your requirements. Let's go one layer deeper and look into the time horizons. If you plan to invest it for less than 2 years, then you are better off keeping this as cash because you might need to withdraw it soon. But if you plan to invest it for the next 3 to 5 years, then you can invest in broad index funds. But if you have more time in your hands and you want to invest it for the long term, like 5 to 10 years time, then you have a lot more choices that you can invest in. You need to always do a quick self-check. If a 20% drop in the market will immediately make you panic and sell it, set your stock allocation low from day one. Consistency beats intensity. A simple plan that you can stick to will beat a complex plan that you will abandon. Mistake number 2, trying to time the market. This is the second mistake and honestly one of the hardest to avoid. People trying to time the market. People say things like I'll buy once the market cools down, or I will buy when the next crash comes. Here is the truth. No one knows when the markets will go up or down. Even professional fund managers cannot predict it accurately. If you try to jump in and out of the market, you will miss some of the best days in the market, and that can seriously hurt your returns. There is a famous saying, time in the market beats timing the market, and that's true. What's the solution to that? Set up monthly investing. So set up a direct debit every single month into your investing account. This is called pound cost averaging. That means you invest same amount every single month regardless of what's happening in the market. When prices are low, you buy more unit. When prices are high, you buy less unit. Over time, this smooths out the ups and downs of the market and you remove emotion from the process. Mistake number 3 is chasing hot stocks or trends. Alright, this one is everywhere right now. So you see an online video that says this stock is the next Tesla or this coin is going to pull 10x this month, and everyone is suddenly piling their money in. The problem, by the time you hear about it, it's probably already too late. Trendy investments move fast. Most people end up buying at the high and selling low. Think back to GameStop, Dogecoin, or AI stock hype. They all shot up, everyone talked about them, but soon after, most of them come crashing down. The people who made money were either early or lucky. Most beginners got caught out in the middle. Instead of chasing the hype, focus on consistent, diversified investing. Think about things like low-cost index funds or broad market ETFs. Things that seem boring, but they actually work. As Warren Buffett says, stock market is a device for transferring money from the impatient to the patient. So be the patient one. Mistake number 4, ignoring fees and taxes. This one is sneaky because it doesn't sound like a big deal, but fees and taxes eat into your returns over time. Let's say you invest £10,000 for the next 20 years and it grows by 7% every year. If you pay just 1% fee, that tiny difference could cost you around £40,000 in fees. That's years of growth gone. Always check your platform fees and fund fees. Look for low-cost index funds and compare different platforms. Some charge a flat fee, whereas others charge a percentage. And then there is tax. If you invest outside an ISA or a pension, you may have to end up paying capital gains tax and dividend tax. The easiest fix is invest inside a stocks and shares ISA or a SIP. This will make sure you keep more of your earnings, because it's not just about how much you make, it's also about how much you keep. Mistake number 5 is letting emotions take over. This one might be most important. Emotions ruin more investing plans than anything else. When the market crashes, beginners panic and sell. And when the market is on the rise, people have the fear of missing out and buy more. Both of those reactions lose money. Look at 2020, when the markets crashed around 30% in a single month. Most people sold for a loss. But within a few months, the market came rushing back to all-time highs. The people who stayed invested came out fine, but the people who sold locked in their losses. So here's what you can do. Have rules for yourself. For example, I won't sell unless my goals change. I will only check my portfolio every few months. I will rebalance my portfolio only once a year. That's it. Successful investing is not about knowing everything. It's about staying calm when everyone else is panicking. If you can avoid these 5 mistakes, you are already doing way better than most beginners out there. Investing isn't about being perfect. It's about being consistent. Even small steps done regularly can grow into massive overtime returns. If you found this video helpful, hit the like button. It really helps people find videos like this. And subscribe for more money and investing tips every week. Thanks for watching, and I'll see you on the next one.